Well, the sales tax audits aside, I know that's probably one of those big areas that everyone feels the pain, and hopefully we don't see too much pain coming out of this Affordable Care Act. We think about when the IRS brought out uniform capitalization. It took them almost 10 years before they made our life miserable, but now every audit, the first thing they want to talk about is uniform capitalization. So, with respect to what we're talking about here today, we want to go through to cover this new reporting requirement. Why do we do this? Why is this such a far-reaching information gather here? We're going to review the forms and the applicable deadlines for these filings. We're going to look at what those penalties for noncompliance are, which see point A. The reason why we're even doing this is to say, hey, we know we have certain penalties for not abiding by the individual mandate. So every individual has to have coverage, or their spouse has to have coverage that covers them. Then you say, well, the employer mandate. Well, everyone has to provide this minimum essential coverage that provides that minimum value to everyone. And so have we accomplished that? And then lastly, well, if the business isn't going to cover the cost of this plan to someone, then the government will cover that, and then they'll do that through some sort of a subsidy, because that's because of the fact that that was not going to be an affordable coverage. And then loop that all the way back to say, okay, well, if someone's out there on the exchange getting this coverage with this subsidy, and separately their employer reported them and said, hey, you are provided this minimum essential coverage and it's affordable, then that individual shouldn't be out there on the exchange getting the subsidy. So it's a very ambitious plan that the IRS is hoping to accomplish with all of this reporting, and it's all new this year, so we're going to have a lot of fun with it. We're going to look at what information is needed to complete the forms. We're going to look at the forms and kind of talk a little bit about what preparation of those forms look like. We're not going to take a real deep dive into the actual forms. I'll point out a couple of things that I want to note or have you note. But if you are interested, and we could do a show of hands, but that never works in this setting anyway because nobody's raising their hand right now. But what I think we'd find is we're not really all going to prepare these returns. We have payroll providers who are going to help us. So let's talk about what we're going to actually need to know to help the payroll providers get this information into a complete and accurate return. And if you are interested in the form by form, check out our national office did a very deep dive onto the forms as far as coding goes and under what circumstances you might see that. You need certain codes. And that is available on our website. It's also available on YouTube. And so you could check that out. We're going to talk about what you need to do to prepare, because these forms are due very quickly here. And we'll talk just very briefly about one solution that we have provided to our clients to handle this, just because for some people, they have either certain requirements that require them to file that their payroll provider hadn't really anticipated, or they may in some cases just choose to use, some of our clients have found that it's very expensive to add this option through their payroll, and so it made more sense to just have us handle that for them. We've talked a little bit about the goal behind this reporting. It is really all about assessing penalties to some degree, that we want to know who's covered, who's not covered, who's kind of taking care of the appropriate minimum requirements that have been set out by statute. And so you think about here we are in the Illinois Manufacturers Association. Some of our favorite credits and deductions that we think about would be, say, domestic production deduction. I was thinking about in the car on the way over here, DPAD has to be more favorite than research, because not everyone's doing research, but everyone is producing domestically, it seems. And so when we look at that, we say, well, if we want a 3%, let's just say it's a 3% reduction in our tax rate, then we will produce domestically. Okay, we can make a decision. You put that carrot out there. Some businesses will go for it. Some businesses will say, you know what, I still find that it's better to produce in China and bring those parts here and distribute here or do what I'm going to do. But we've made a decision, and we can either go for that 3% rate reduction or not. Likewise, research credit. Well, I could produce here in the U.S. and I can do the research here. Maybe I'll put that in Alabama, and I have some great engineers out there, or I'll use a team. However you decide to do it, we're going to do it here in the United States, and the benefit is that we get a credit, and we can reduce our tax dollar for dollar to the extent that we're doing some research activities here. So again, we get that beautiful credit that we can take against our taxes and that incentive for us to do that research here. But here what we're talking about, as opposed to that carrot that we can all maybe choose to go for or not, instead we say every single person is going to do this. It is the law. And so instead we're going to just take the stick approach. Why give you something to go for some incentive when we will instead just abuse those who don't go for, take care of this minimum essential coverage and providing affordable health care. So, when we look at, we kind of talked a little bit about that individual mandate. Everyone has to have coverage. If not, they could be subject to a small penalty, which ramps up over time. And so we're going to need to know who has minimum essential coverage. So that means that the employer has to tell someone whether or not they have this minimum essential coverage and whether it's affordable. So from a standpoint of this mandate, we are all required to report this so that we can see whether anyone's getting, whether we owe that cost share subsidy or the pay or pay penalty, or it could indicate that someone should not necessarily be receiving any premium tax credit on the exchange. We're going to have to report if we have 50 or more full-time employees or full-time equivalents, and we're going to have to essentially be sure that we've, assert that we've complied with the mandate to provide this coverage. And if we look at what this means, because we've kind of talked a little bit about what, kind of using this term 50 or more, and we're going to go into that a little bit later here. But it's pretty bad when the first thing we have to do is define affordable, but here we are defining that anyway. And in fact, once you read what's affordable, you say, hey, we all know what that means. Okay, 9.5% of household income. Like, okay, that sounds perfectly reasonable. Now I'll just go to every person and I'll find out what their household income is, and I'll be sure that it's affordable for them. And unfortunately, that's not administratively practicable. So instead, we say, well, what do we do for this case? Because I don't know what anybody's household income is, and nor would they tell me. And would they tell me the right number? Ask anybody in the room what their adjusted gross income was last year. We don't know. So it's really just a matter of having a federal guideline that we can use, and we're going to kind of look at what that is later. But it's based on a poverty. This is essentially the poverty line as saying this would be affordable, a kind of a government safe harbor. And it breaks down to about $93 per month in insurance cost. So if someone's paying more than that $93 per month in insurance cost, it doesn't mean that you've lost, that you owe this penalty necessarily. It just means that we're going to have to use some of the different tests to get there. And so some of those tests would be kind of another variation on this measurement. So if you instead said, well, I'm going to determine whether this is affordable because I'm going to look at their rate of pay. And we'll kind of get into some of this a little bit later as well, but the rate of pay safe harbor, we say, well, look at their hourly rate. What's the lowest rate that they were paid during the year, and take that rate, apply it times the 130 hours, and that would be their rate for the month. With respect to kind of the other safe harbor, that would be looking at the box 1 of their W-2. So that you say, well, is it affordable as it relates to, does it exceed 9.5% of my box 1 W-2 divided by 12? And if it meets any of those other tests, we can call our coverage affordable, even though it may not meet that safe harbor. And so those are going to be some of these key exemption codes that you see on the form that we talk about a little bit later. And that's really what they're getting at with respect to this. But you think about there's a certain beauty to the way this is designed, in the sense that, when you look at your box 1, what's in box 1? Typically it's going to be, you're going to talk about your gross pay, and then you're going to back out from it anything that's provided on a tax-free basis. So if you have someone who's already taken, made a $2,000 contribution to their 401k, or if they have paid health insurance premiums on a tax-free, pre-tax basis, those numbers have all been backed out. So you're actually not looking at their full rate of pay. And so I would guess that the W-2 methodology may kind of exacerbate some of the problems in computing whether or not a coverage is affordable. And that gets back to whether or not I owe a penalty under the pay or pay mandate if I'm over 100 employees. And so we really want to make sure that we're using the appropriate method to determine affordability. So minimum essential coverage, that sounds really complex. Like, do I have to provide this person a medevac, if they get hurt scuba diving while they're on vacation in Cozumel? No, it's not talking about what kind of coverage I have. It's just saying, do I provide an employer-provided plan, or do I have a government-provided plan, some formal plan to provide this, and do I cover at least 60% of their cost in calculating their benefit under the plan? And with respect to this cost, it's not just looking at, say, the amount that they're going to have to pay. It could look at, it can look at the high deductible amount as well. So just keep in mind, when you have folks that are using that high deductible plan and say, hey, you only pay 20 bucks a week, you also have to factor into that some of the other amounts that they may be required to pay outside of that. Now, this is not something that we have to do right now. Your insurance company, if you're using a fully insured plan, they've already done this when they calculated your plan. And so this is going to be kind of an assertion that you get from your provider that, yes, we have designed a plan that is affordable under this plan. So we've also kind of been talking about employees. We haven't really talked about the fact that that's saying, okay, well, I know who my employees are. They're full-time, they work 40 hours per week. Well, you know what, if you're full-time, that's one calculation. Take the total, count them all up for any given month, divide it by 12. You're going to know what your total your amount per month is for that monthly basis, or do it by the year and calculate that number. And separately, we're going to look at how we calculate full-time equivalents, which is going to be based on people who work certain number of hours and can essentially be pulled in for purposes of determining whether we're an applicable large employer. Now, the reason we care about this is because I'm going to tell you guys something really exciting here in the next few minutes that may mean that some of you get to get up and walk out of here. And the reason is that you may say, well, I'm not covered by this. I don't have to report. You're going to show me some transition rules that might allow me to not have to do this. And thank you very much, Andrew. I want to just take a moment to shake your hand, and then I'm going to leave. No offense to you. I'm sure it's a great presentation, but we're not going to report. So if you look at some certain people who are covered here, we have our health, if you're through a health exchange, so this is out on the exchange, you're going to get a 1085A. You may be getting a subsidy, you may not. I think we're all pretty familiar with this. We probably saw a lot of clients with this last year because some of the exchanges were reporting this last year. And it kind of shows each month who's covered by what, and we're really not going to be impacted by it. Now, if we're through a sole proprietor who just has a private plan, so they're covering just themselves and they're not under kind of this minimum essential coverage for the plan, they essentially the insurer is going to handle the reporting for them. They have it made. Same thing goes for if you have 50 or fewer full-time or equivalent employees, that the insurer will handle the 1095B and no responsibility to the employer for reporting. Now, I haven't told you how to count 50 yet other than the full-time and full-time equivalents. And so we have to take into account attribution, which is going to, that affiliated group rules and affiliated service group rules. And so don't leave just yet, but as soon as we make sure that you're not impacted by those rules, then we can, figure out whether this applies to you. Now, where we're really going to focus our time would be the fully insured employer with 50 or more employees, because they're going to have to fill out 1095C parts 1 and 2. And then we're also going to talk a little bit about self-insured, because you think about what the self-insured company is, they're a little bit like an employer because they have all the employees. They're also a little bit like an insurance company because they pay all the the cost of those amounts that would have been covered by an insurance provider. And so for that reason, you'll see that the self-insured have a bit different reporting requirements. You'll see that that under 50 full-time equivalent employees, we have the employer's obligation to report, and the same thing with 50 or more, that everyone is filling out and reporting for, on everyone covered under the plan. And we're going to see how that varies compared to an employer reporting on, in a fully insured plan, because we're going to only worry about our employees in that sense, as opposed to someone on a self-insured plan that they're really reporting everyone that's covered under the plan. And so it is, for the self-insured companies out there, it's going to become a little more arduous of a task to report. So you'll see that's why we've kind of broken that out into what each company has to do depending on how they fund their plan. That if you have 50 full-time equivalent employees, they're going to use a 1094B and C as opposed to the 1094C or 1094C, I'm sorry, I just said that backwards. You're going to use a 1095B for the small self-insured, and you're going to use the 1095C for the large self-insured, which is the same as a large fully insured to some degree, although we're going to fill out different parts. Now, the 1094 forms, think about those. I know we all love our 1099s. At the end of the year, we put all of the 1099s together, and we put one 1096 on top to say this is how many forms that we've prepared, and here's just kind of a lead sheet to go with it. That's really the equivalent of what we have here with those 1094s, that's our lead sheet, that transmittal for what's behind it, which is the reporting that's going to go to every individual employee. So the conversation of how do we measure a 50 employee, again, it's one of those oddities that we say, well, this should be pretty straightforward. But once we look at the law, we find that nothing is ever that simple. And so we are going to count up those 50 employees. We're going to look at everyone who was here full time, meaning that they were here for 130 hours during any given month. And we can then take the 50, anyone who was a full-time equivalent. Actually, you know what, let me hold off on the full-time equivalent for the time being, because I want to just address a couple of things. If we were not in existence in the previous calendar year, then we're going to base this on who we reasonably expect to have on our staff as of that 2015 period. Because the first thing that we're talking about with respect to our measurement period is we're looking at 2014 for calculating how many employees we had. So if we had, if we had 50 more or 50 or more during a given, for the entire year, when looking at the average monthly count, we will end up with a reporting requirement. There's also a special transitional rule this year that says that we can look back to just any consecutive 6-month period of the 2014 year. And we can kind of see if there's this opportunity to avoid this reporting requirement in the first year if we're close. So if we have, during January through June, we ended up having, 48 people, and the latter half of the year, business picked up and we staffed up a bit. You can still avoid this for another year. Now you're just kicking the can down the road, but it gives you a little bit more time than, say, January to do this reporting. Another issue here is that we may have people who trip this test because they hire up a lot of seasonal employees. So someone might have had a lot of people on staff during the select few months out of the year, but in general, they're under 50 employees. So if you find that someone counts back and looks at their employee count, and for only 120 days or less, they tripped themselves over the 50 employee count. And if those 50, to the extent they were over 50, only relates to the seasonal employees, then they're given essentially a safe harbor here that as if they did not have 50 employees. So then we say, well, okay, but what if I wasn't around? We say, okay, well, what would we reasonably expect someone to have done here? And kind of in the same vein as how many people do we reasonably expect to have on staff, is this conversation of someone who may be out there working on commission. Well, I don't know how many days per year that person is working for me. I don't, they're an employee, but they're on the road, they're traveling. I just don't know what they're doing. They're not punching a clock. Just so long as they're showing results, this is what we're going to do. Well, how do we test whether or not they're full-time? And with regard to this, we say, well, either we can look at assume an 8-hour day for the days that they work. We can assume a 40-hour week for the weeks that they work. But we just can't exclude their time traveling, and we have to be sure that we're not intentionally counting time that is time that they're working. Or not counting time that's time that they work. It needs to be reasonable. And so there may be other questions here as well, and I'm trying to cover a couple of things that you guys might be thinking of, but this is not always so simple to determine whether we have 50 employees. And here we're just because of the way we're, what we know about what our folks are doing, and then on top of that, we need to take those full-time people and look at full-time equivalents. So kind of talked a little bit about this with respect to a look-back measurement. Maybe just to mention here that sometimes we may hire people on and we know they're working 20 hours per week. And then pretty soon they're doing a great job and they pick up hours and now they're full-time. And then they're in this window where they're maybe not covered for, until they hit 6 months' time or 3 months' time. Who knows how long they're waiting exactly before they're covered by the plan. But now all of a sudden you say, well, I think I might be required to provide this person with coverage, and yet I just don't know. I don't really know when I tripped over that line. So in this case, if you have people like that, just be aware that there is a look-back methodology. It depends very much on the facts and circumstances for each individual, because it depends on a lot of the requirements on your plan, as I mentioned, with respect to the limited assessment period where someone's not covered. It just depends on so many things. And so I want you to be aware that it's out there, but it's tough to give you a bright line test for purposes of the look-back measurement method. So full-time equivalent employee, so we've counted up all of our full-time, that was easy. Now we have to look at full-time equivalents. We say, okay, well, these people, they're working 120 hours a month or less, and I'll say, well, because maybe they worked 130, but we don't get to credit them 130 if they worked a tick more. We just look at 120 of their hours. And then we add up all the hours worked by people who aren't full-time, and we divide that by 12, and that monthly number is the number of employees that we add to our actual full-time employees, and then we determine whether or not we're at 50. And the exciting part is we're still not done, so I'll go one more slide, because sometimes employer doesn't mean employer. Say, okay, well, I know I've added up all the full-time people that work for me. I've added up all the full-time equivalent people that work for me, but I haven't added up all the people that work for other people who are related to me. And so if that's the case, certain circumstances may require that we look to an affiliated group. So I think that everyone feels comfortable thinking about kind of a parent-subsidiary relationship where you can see that, hey, I own 100% of this company. It makes sense that I would be kind of tested together for purposes of, it's not just this area of the law, it's with respect to any plan that we have for discrimination tests and so on. That will happen kind of as a group in most cases. And in the same way, we have to do that here for purposes of determining whether or not we're a full-time or whether or not we're an applicable large employer. And so, if we have that parent-subsidiary relationship, we have that one company that owns us, but we're all related. Here, let's say you see this a lot, like with some of our clients who are, foreign direct investment. Well, there's a 100% owner in Japan, let's say, and then we've got different subsidiaries that are doing all sorts of things here, and they are not filing a consolidated federal income tax return. They're just required to talk to one another about how they divvy up their tax rates. In the same way, they have to talk to each other about how many, essentially who needs to be part of this group for purposes of whether they're a full-time equivalent. And this isn't really going to matter that much to them because they all have more than 50 employees. But where it's really interesting is that this control requirement that we all know and accept in the brother-sister affiliated group or in a parent-subsidiary relationship applies also where we have someone who maybe is just the money person in an investment. So if you come in and you say, this person gave us $10 million to start our business, and they took a 55% stake in the company, and then gave out profits interest to these other folks. And we have an example here a little bit later about this fact. So we come in, we put in a bit of money, we take 55% back, we form a partnership. Separately, we have an S corporation. We have 15 prior year average employees and full-time equivalents. We have an S corporation where we essentially, it looks like my numbers got messed up a little bit there on my slide, but that entity type, let's just imagine that it says something like 90% instead of an entity type there. But nevertheless, we have an ownership percentage where we control. And similarly, our other investments, we've kind of put this money in the investment, we control the investment, and nowhere along the way does anybody have more than 50 employees or equivalents. And what we will find in the case here is that just because we control, we are treated as a full-time employee or an applicable large employer, subject to the reporting rules that we've talked about here under filing the 1095Cs that we mentioned a moment ago, where previously you looked at the form and you guys said, oh yeah, well I only have 3 people working for me, or over here I only have 15, but in fact your business is owned by some person, and I'm glad you guys didn't leave because this may apply to you. And so if that's the case, we still have to do all the reporting even though no entity has less than or greater than 50 full-time employees or equivalents. So you'll notice that it also doesn't matter that we're in separate trades or businesses. It doesn't matter that we owned them in an entity or in a proprietorship. It only looks to control. And so with that, we just kind of summarize what our requirement would be, that we would still have to file the 1094 and 1095C. This is because that we're required to group any trade or any activity controlled, any separate trade or business that's controlled. So you notice that we didn't have rental properties on there. Even if I had employees in a rental property, I don't know that it would rise to a level of a trade or business in this case. And so you have to make that distinction if that's a fact pattern that you see. But we would be required to group for purposes of counting that 50. And so this also just mentions that we would keep in mind whether or not we have a relationship with a management company that might need to be brought in or other various entities that are under common control. So I know you've kind of seen this in another form already. I want to put that up here for purposes of just summarizing this because I don't think repetition ever hurts anyone. I think it also gives us kind of this nice summary of who has to report what. And these slides will be made available to you guys so you don't have to take fervent notes on these things. So with that, let's talk a little bit about the due dates. This reporting, much like those, the forms W-2 that we're going to provide to our employees, is due to the employee by January 31st. So we have to receive, get all this information in, get the files prepared, or get the forms prepared, and be ready to present these to these individuals so they can file their personal tax returns, because they need to be able to say, yes, I had affordable coverage, yes, I was provided minimum essential coverage, and I'm going to have to check a box on my tax return that says that I was provided these things, and this is how they know. So that's due January 31st. If we're going to paper file, we have to have this done by February 29, 2016. Actually, one other note, January 31st falls on a Sunday, so you actually get till February 1st this year, but nevertheless, end of the month. If you prepare everything electronically, you get an extra month to get your act together, get your coding all finalized, and get that submitted. Now, I guess for 2016, that's maybe the electronic filing looks preferable, but I was doing a little bit of thinking about this, and actually for the next year, if our due date is February 29th, we have until February 29th, 2020 to get it done for the next year. So just because it's a leap year, we get that extra 4 years to file. I think that's the way it's going to work anyway. I don't know. But in all seriousness, we get a little extra time if we e-file. And so keep that in mind. Late filing is another potential for $250. You add that on to potential penalties that we might be calculating. We don't want to get late filing fees layered on here as well. So now I want to just jump through the forms a little bit and point out a couple of things that may be of interest to you guys. With respect to the 1095C, Keep in mind that what we're talking about here is really for the applicable large employer, or in some cases a self-insured plan would also be required to do this. A self-insured plan prepares parts, I believe, 1, 2, and 3, as opposed to someone who has insurance or a separate insurance company is going to do parts 1 and 2. So we're going to do, you're going to know all of this information here, the name of the employee, the social security number, and so on, because we were just talking about who's covered. This person's on payroll. We have this information available. One thing to keep in mind, that contact telephone number, make sure you get a good number on there. If anyone calls with any questions, make sure that like I have Ryan Peterson with me here today, the director in our accounting outsourced service group, and I would put his number on anything there so that he can handle all these questions. But make sure that if you're going to put out 75 of these forms, make sure there's a number on there that you want them to call and not your front desk if there's a specific question. For part 2, just looking at what this does, line 14 says that that's the offer of coverage, and that this is required. We have to indicate what kind of coverage offering we had made available, or if we had an exception for providing coverage, why did we not make an offer of coverage? The line 15 is where we go through and we calculate each employee's share of the lowest cost premium that they could buy, employee-only plan. So if that one in that example I told you before, well, let's say we charge them, $30 a week for their plan, and that's the cheapest option that they have, then that line would need to say, perhaps say $120 on each of those lines that they had, the months that they had coverage. And then line 16 tells us that we have essentially an exception from a penalty. So that's my favorite line. I like those lines where we give them information about why we don't owe penalties. And since this is the whole reason for the form, even though there's a reason, the instructions give us the opportunity to leave it blank if no code applies, look for a code that applies. Let's tell them why we don't owe the penalties. So just kind of looking at line 15 instructions, I just want to point out that if lines 1B, 1C, 1D, 1E are entered on line 14, then we're going to have to populate line 15. But in other cases, we may not have to explain why what amount that we calculated for each monthly employee. One of those exceptions being that, well, if we're under that $93 per month for 2015, then we're going to be okay. We don't need to tell them how much they actually charged. It's just under that amount, and it's told by the coding will explain why that has occurred. So just want to look at this line 14 code that I was talking about, this qualifying offer. I want to point out that this is really a qualifying offer is where we were talking about that 9.5% of the household income, but really what we know that to mean is it's based on the single federal poverty line. So if we say, I don't want you to look at that line 14 offer and say, well, I provided minimum essential coverage, I provided minimum value, done. I'm going to put in 1A and I'm perfect. But what we may find is if, let's say we have, if we are at that 60% threshold, you may, as far as that minimum value, we may not also, either maybe the insurance is cheaper then, and so they are under that $93, or if we say, hey, we're going to cover a little bit more, 80% of the value, maybe they end up below that $93. But a lot of times we have found so far that people are not able to satisfy this test based on the single federal poverty line. And so that if people the folks in your organization tend to earn a little bit more, it may be reasonable that they end up paying a couple $100s a month for the coverage that they have. It is still affordable, but we're going to avail ourselves of some of those other safe harbors that we talked about previously, which was based on either the rate of pay safe harbor or the W-2 box 1 safe harbor. And there's plenty of other ways of looking at this too, but that's a couple of the offers that we have. So 1B through 1E are all talking about the various iterations of the minimum essential coverage that we've provided this. Box 1F is essentially minimum essential coverage without minimum value. And 1G is for a self-insured plan. 1H is, hey, we didn't offer any coverage, but there may be good reasons to do so. And qualifying transition relief, we'll kind of just talk a little bit about that later. It says that we must have a qualified offer, at least 95% of full-time employees. For our first year, we get to make sure that minimum essential coverage is offered to 70% as part of a transition. That's basically what that's speaking to. Line 15, as I said before, we just enter that in certain circumstances. That may be okay to leave line 15 blank. It's going to be based on the lowest month, the cost that is available to them in any given month, regardless of if they enroll. And just to keep in mind that if we have calculated that their share is really zero, put zero, because company is paying 100%, be proud of that. Put the zero on the line and indicate that their share is nothing. Now, in the case of a non-calendar year plan, something to keep in mind is that prior to, think of what happened back in, February 14, or when, I believe that's when we got some of this guidance. We got the rules about what it means to be affordable. So if your plan is on a fiscal year and you didn't sign up, or you didn't, have that plan for the entire year, when they came back out and helped you get in compliance, you've got a couple of months that might have been unaffordable, so to speak. It hasn't been calculated in that total cost. And so where your full 12 months to hit affordability you may need to go into March of the next year to get there. And so just keep in mind that with respect to a non-calendar year plan, you can use an average cost with respect to that cost, the cost of coverage. So, in some cases, one client, a client of mine, if you looked at their monthly coverage, they're not affordable in the first part of their year. But on an average basis, it does meet the definition of affordability. So just looking at some of these codes, and again, I don't really want to go into too much here, but I want to just highlight 2F, 2G, 2H. As we look at the affordability safe harbor, maybe we should highlight 2E as well, because if we have a collective bargaining arrangement, we may have folks that we don't even know whether they have minimum essential coverage. In that case, typically the union will tell you or give you some sort of an assertion that yes, we've provided them minimum essential coverage, it's affordable, and you can go ahead and give the exception code to say, hey, I don't really have any information other than the fact that they're covered under the union plan and it's sufficient for these rules. With respect to the W-2 affordability safe harbor, we kind of talked about some of the risks of that already. The federal poverty line, the $92.39 is actually based on the 2014 poverty line. $93.18 is based on 2015, so it just depends on when, if you're looking at a calendar year, you're going to be using the $93. The affordability safe harbor, that rate of pay safe harbor that we all now know and love and say, hey, we have our eye on this as something that we're going to use. Keep in mind that that's based on the lowest rate that we've offered them during that year. So it's either the lower of the rate they had as the date of the first day under the plan, or the lowest rate they were offered per hour at any time during the month. And it does not apply to an individual employee who has experienced a reduction in hours for any reason. So if their monthly compensation goes down for any reason, either you say, well, they were working out fine, but now they're not working out, we've cut their hours, we had to, that production line had to close down for a bit, and now we're not using them as much. Whatever the reason is, they cannot use that safe harbor for them. All right, so 1095C Part 3, if you're fully insured, I kind of mentioned you're going to do Parts 1 and 2. This part is what we have left, because this is where the self-insured employer is going to step into the shoes of the insurance company and say, yeah, here's the period that we've covered these individuals. And here's the periods that they were covered, either all 12 months or in which periods they were, that they had coverage. Now, one thing here with respect to essentially a self-insured plan is that we're talking about covered individuals, and that distinction is kind of important in column A, that it's talking about not just people who are covered because they're our employee, but anyone under the plan, similar to an insurance company as to what they're going to report on their 1095B. And so we may not even know the Social Security number of our employee's spouse, but yet we're required to put that on here. And so it's, again, for this reason that we want to get that information going requesting that right away, because we're going to need to put the name of every covered individual. We're going to need to put their Social Security number. If we have made a request or multiple requests for the Social Security number and have not received the Social Security numbers of those covered, we can just use the date of birth. But we do need to maintain documentation that we made requests for the Social Security number. We cannot just leave that blank. The 1094C, again, this is going to be the essentially the transmittal form that's going to go for our applicable large employers. We're going to fill out 1 through 7 with all of our employer information. So this, again, is people that are 50 or more full-time and equivalents. You'll see box 9 says name of designated government entity, and essentially what that means is everyone's going to leave 9 through 16 blank, because for the most part we aren't going to see that this is an issue unless you have, essentially what you could say is, you could say, well, the state of Illinois has a couple of other government offices and they're all going to report on one, and so we can let someone be our reporting entity in that case, and then we just won't file. And in that case, I recommend you save the letter where they say, yes, we will report for you, so that you're sure that you've handled that. So we're also going to indicate the number of 1095Cs that we've submitted. In some case, that may look a little odd because we're going to put 5 on there, and in which case we're going to indicate later that we're part of an aggregated group. So that's here, the ALE member information, and say, okay, well, was this part of an aggregated group? And we're going to check the box yes if we're doing that as part of, if we're bringing people in under that, essentially I would just call it that aggregation rules, but there are various rules under 415 that bring that together, similar to all of our other qualified plans. And so we would say yes there, and we're going to do a couple other things here on the next slide. I'll just advance that for a moment. We're also going to put in the name and EIN of up to 30 people who are part of our aggregation. Now, this is not a consolidated report. This is just putting the IRS on notice that we're part of this aggregation, and so each employer will file their own report. Now, the other thing to keep in mind, and let me see here, I want to just, all right, I thought I might have forgotten to tell you guys something here, but I wanted to skip back for a second. Here, is this information the authoritative transmittal for the ALE member? And so what I want to kind of distinguish here is that this ALE member is really one per employer. And so I don't want you to look at that box and then say, okay, well, now we're talking about our ALE member information, and that this is some sort of a consolidated return that has to kind of include the numbers for everything. What this authoritative transmittal box is for is it gives you the ability to say one EIN that we're filing under has multiple offices. So let's say our California location does their own payroll and these other offices do their own payroll. They have the ability to allow their payroll company to do their reporting for each office and then take the sum information from each of those reports and combine that into one authoritative transmittal. And so in that case, what you'd have to do essentially is file a consolidated report. But it's only if you have the same employer identification number reporting on multiple separate reports. So for that reason, I suspect that most people are going to essentially just do it as one massive filing anyway, and just pull all the information together and do it that way, because you have to end up doing that anyway. So you may as well do that the first time and avoid all those separate filings. Just to want to skip back here for 1 second as well to look at some of these other, and I know we're kind of jumping around a little bit, but this is all the transmittal. So this is the same for all of, this is kind of the, if you have 50 or greater people, whether you're self-insured or fully insured, you're going to be preparing this form. And so just to point out this transition relief here in Part C, Section 4980H transition relief. And for those of you who are really excited and into this, you know that that's where we get our pay or pay penalties. And so this is why you're saying, why can I not be penalized? So let's just tell the IRS one last opportunity. I've given you guys all the codes why I shouldn't be subject to penalty. Why do I have an exception from penalty? But here's our last ditch effort to avoid penalty or experience a reduced penalty as part of our transition. So there's two things that we have going here. If you're between 50 and 99 employees, and we didn't find out about the new rules under Obamacare and immediately reduce our coverage, and we didn't immediately cut everyone's hours down to 30 hours, and we didn't really do anything like that. We just continued covering everyone for the period that we're testing here. In that case, you can check the box C, and then you can, what did I do here? Sorry guys. And then you can go here to the transition relief and put a letter A in there. And essentially what that means then is that we are not going to be subject to any pay or pay penalties in our first year because we weren't really trying to game the system. Sure, maybe all things considered, we did our very best to provide affordable coverage, but we're on a fiscal year that ended in November. And we have 1 month of these qualifying premiums and a full year of unaffordable premiums. And there's no way we're going to qualify, but we're 50 to 99 employees, no penalty. That's basically one alternative. The other alternative for box C is that I have 100 or more full-time employees and equivalents. And I look at that test and I say, you know what, I think I may be subject to some penalties here. And if that's the case, I know that some of you may be familiar with this idea of, well, I get 30 free. And so the first 30 failures that I have are not going to be subject to penalty. By checking that box and putting code B in the transition relief indicator, you can move that number to 80 in the first year. So if there's any chance that you think that you're going to have some penalty and you're over 100 employees, you need to check box C. Now, the full-time employee count and some of these other things, I know we have a lot of great information about these on our website, but I don't want to get too into the weeds with the forms. Probably I'm there already from the looks of you guys that this is no longer fun. So let's just see if we can go to the real quick, looking at the small employer who is a self-insured small employer. So they're under 50 full-time equivalents, but they still have to do all of this reporting because they're kind of filling two roles. They're the insurance company and they're the employer. So in this case, they're going to complete parts 1 and 3 only on the 1095B. They're going to fill out all of the information is similar to what we had talked about previously. The reason, I think it's pretty clear, part 2 is not applicable because it says, well, here's the employer plan that we've covered them under, and we don't have an employer-sponsored plan. We are the insurance company, so to speak. We're still going to report the covered individuals. We can still use the Social Security number here, but again, in the case of the self-insured, this self-insured plan does not just include employees, it includes everyone covered. So make sure that there's that distinction if we are filing a form like this for a self-insured plan, that we include everyone covered, including part-time, whereas if we are the employer, we're really just talking about our full-time people who are covered under the plan. So this would be the transmittal for that. That's going to be that equivalent of the 1096 that goes on top of our 1099s, just saying here's the number of forms that we're filing. And so, really just with respect to what we've seen, I know that a lot of what we're going to have available to us is the use of payroll providers handling these forms for us. But I think that a lot of you would find that, how much of that information could actually be pulled from your payroll records? There's going to be a great deal of work for people who are looking to prepare these forms and meet the deadlines that we talked about. So really, we need to be thinking now about whether or not we have any controlled group that need to report. That includes, as we looked in that example, of a control between just common ownership, regardless of whether or not it's in a tier of entities. So we also want to make sure that we're communicating to everyone within the group to say, hey, make sure that you're at least reporting our ALE members so that we're all making sure that we're aggregating for purposes of those tests. We want to kind of dig into some of these fundamentals that we looked at a very high level and make sure that we understand how that applies to your specific organization or to your clients' organizations. And then lastly, we want to know what information we have to collect and by when. And really the best thing that we can do at this point is to kind of calendar when we're going to meet these various milestones. And the very first thing we can do is we can go back from January to October and start counting up these people, start looking at for what periods people are going to find that they don't have coverage or do have coverage, or what coding is going to have to happen. We had one example where somebody came in, they were hired in say February part-time. They were in their grace period where they didn't have coverage for a period of time, but in April they became eligible. Then in April they declined because they were under their parents' plan. Then in June they came off of their parents' plan because of a qualifying event and they became insured. Then they, by the end of the year they were no longer with the company. And so you've got 5 or 6 codes for this one event that needs to spend some time with. And so there's going to be a fair chunk of what you do that you'll say, yes, these people were here all 12 months and they were offered coverage and it was affordable, and so we've done that test and we're okay. But for those outliers, kind of, I think we've all heard before, you spend 80% of your time on 20% of your problems children or whatever the company. In the same way, we're going to spend 80% of our time here on those 20% unique circumstances, and we really need to understand what happened and help get that information done now, because if you look at the number of workdays left on the calendar right now between Thanksgiving and all the holidays, there aren't that many workdays left to go back and count this up. And what you really want to do is in January, you want to be looking at December only so that you can meet this January 31st filing requirement. So with that, I will just mention quickly that we have a solution for this. We have kind of a fixed cost that will come out. It includes a 3-tiered approach. So that we'll sit down with you and help identify these instances where we may have special reporting that needs to occur. And we'll provide you with a copy of our playbook, which is it's as exciting to go through as this presentation was here today, but you'll have someone here coaching you and walking you through that and making sure that you're getting things off on the right foot. Separately then, we would provide you with our template to provide all that information into our cloud system, and then lastly you can provide it to your client or the individual filer, the entity that's filing, and they can review everything, sign off, and make sure that that's accurate, upload everything, send out. We will send out all of the 1095 issuances to the employees, and everything is handled for you. So the other thing to keep in mind is that some software packages that you may be using have this built in. Depends on the version that you're using, but it either may be an add-on that you can acquire, or it may be something that you already have. And so if you are working on any of these software solutions, SAGE, Intact, Dynamics, Great Plains, you can contact some of our principals in this area and talk if it's of interest to you. And if you're using another software provider, that they may have something as well. But again, these guys are great guys to talk to if you just want to bounce a question off them and see if it's something that would make sense for you to explore. And so with that, that's really all I had. Unless anyone has specific questions, then I'll let Ryan answer everything.